Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, a lot to talk about, so let's start straight with the Bloomberg First Word News. And we start in the U.S., a sign of compromise in the stimulus deadlock on Capitol Hill. House Speaker Nancy Pelosi says the Democrats may be willing to make cuts to the rescue package to seal a deal with Republicans. But she'd then want to come back after the November election with more items on the agenda. A senior official tells us the White House sees a possibility of a pared-down package of around $500 billion. Now, the U.S. is suspending changes to the mail service. That's after concerns over the slow delivery of ballots ahead of the November election. Democrats have accused President Donald Trump of hampering mail-in votes, and the Postmaster General says he's shelving the changes to avoid even the appearance of any impact on the election. Canada has named Chrystia Freeland as its new finance minister. It gives one of Prime Minister Justin Trudeau's top aides the job of overseeing the nation's economic recovery. She's been one of Trudeau's go-to ministers for some of the government's main issues, including renegotiating the North American Free Trade Pact. Freeland is the first woman to actually hold the post. And that's your Bloomberg First Word News. Now, Joe Biden, as we were just saying, is officially the Democratic nominee taking on President Donald Trump this November. It was confirmed at the party's virtual convention overnight. Now, the traditional roll call was restyled in the time of COVID-19 as a video tour across the U.S.
Want a president who defines the job as spending hours a day watching TV and zapping people on social media? He's your man. Denying, distracting, and demeaning works great if you're trying to entertain or inflame. But in a real crisis, it collapses like a house of cards.
Donald Trump inherited a growing economy and a more peaceful world. And like everything else he inherited, he bankrupted it. When this president goes overseas, it isn't a goodwill mission, it's a blooper reel. He breaks up with our allies and writes love letters to dictators. America deserves a president who is looked up to, not laughed at.
Joe Biden will be a president we will all be proud to salute. With Joe Biden in the White House, you will never doubt that he will stand with our friends and stand up to our adversaries, never the other way around.
Well, joining us to discuss all of this is Bloomberg's Kathleen Hunter. So, Kathleen, it seems that the Democrats and Joe Biden campaign wants to make this more about a referendum on President Trump rather than about them.
I think that's absolutely true. Elections where the incumbent president is on the ballot, to some extent, are always a referendum on the sitting president. But I think that's even more true this year because Trump is so polarizing, and also because the COVID-19 crisis has really put the questions about his presidency into stark relief for a lot of people. And so I think that's going to be even more true this year than it typically is.
So how has President Trump and his team been working to counter the Democrats' message?
Well, I think in several ways. We saw the president in Arizona yesterday, for example, at the southern border, talking about Joe Biden and criticizing, what he perceives as Joe Biden's immigration policy to be. We know that immigration and getting tough on immigration has been an issue that Trump campaigned on very hard going back to 2016 when he talked about the border wall that Mexico was going to pay for. I think that, he's going back to that playbook this year and hoping that that energizes his voting base and gets them to the polls on Election Day, and especially in key states like Arizona that could end up being battlegrounds and being decisive when it comes to the overall win.
Kathleen, can we expect a stimulus deal anytime soon?
Well, it's been really, really hard for them to make any progress in negotiations, but there have been some promising signs over the last couple days. Nancy Pelosi is calling the House back into session. She's broken out this part that pertains specifically to the Postal Service, and there are some indications that that could begin to, grease things and get things moving when it comes to the broader package. Republicans are talking about a slimmed-down version of their original proposal. So there are some promising signs, but the two sides are still very, very far apart, so it might be a very heavy lift going forward.
Kathleen, thanks so much. Bloomberg's Kathleen Hunter there, who follows U.S. politics. Now, coming up as we head towards autumn, should investors prepare for higher volatility? Well, that's a warning from the chief executive of Unigestion. We'll speak to Fiona Frick next. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, let's get onto the markets and let's see what we could be expecting from volatility. We talk a lot about volatility, and U.S. stocks closed at a record yesterday, driven by tech and better than expected housing data. Now, as we head towards autumn, though, our next guest warns investors should prepare for higher volatility. She says she's temporarily cutting her positive tilt towards growth assets. I'm delighted to be joined by Fiona Frick, Chief Executive Officer of Unigestion. So, Fiona, good morning to you. How do you see this panning out?
So we believe that the rally that in the last 4 months has had a very strong momentum, and we think that a pause would be quite helpful. We believe that the sentiment on investors is turning a bit, and that valuation of equity are becoming quite expensive on the short term in comparison to historical data, historical PE, while it remains still quite interesting compared to bond yields. So we have a positive view on equity on the long term, but we think that we're going to have a pause in the next months with much more volatility, taking into account that there are some uncertainties around COVID, around the stimulus US pack, around China and US. So more volatility to come.
How much more volatility, Fiona? How do you protect yourself against volatility? I mean, do you just buy VIX, or do you do something else with the portfolio?
No, what we try to do is construct a portfolio which has some convexity, meaning that we buy options out of the money to protect on the downside. Our scenario is still positive for equity on the long term. So if market would go down 5-10%, which could be very easily, which could happen very easily, we would profit to buy again some equities. But in the meantime, we construct some protection with options.
Where do you see the biggest upside, Fiona? When you look at equities, are you positive on European equities compared to US ones, or is it more complicated than that?
There's a difference between the European and the US index in terms of sector allocation. So the US is much more geared toward technology, and the Europe is more geared toward old economies and old sectors such as bank, etc., etc. So I would say I wouldn't necessarily beat against US in terms of Europe. What I found interesting is that the growth of the market in the last 4 months has been very concentrated on a few names. And if you look at the performance of the S&P, except the 5 names, we are still at something like -7, while today the S&P is more on a positive territory thanks to the 5 names. So there is breadth in equity to go up in a perhaps more deconcentrated way.
Is there danger that central banks turn hawkish in the medium term and takes the market by surprise?
We don't think so. And the Fed meeting in July showed that, in fact, they intend to stay there for long. And the rhetoric they used was very dovish. So we believe that, in fact, they'll stay. They changed their role, I would say. In the past, they were more about reacting to the market. Now they are impacting the market. And the rhetoric is very clear that they're going to be there to stay. And they'll be even happy if there is a bit of inflation.
But are you worried, when you look at the main risks out there, Fiona, and if there's one thing you have to get right, I guess it's the fact that we don't have rampant inflation suddenly getting out of control, because that would reprice, frankly, all asset classes. Is that your biggest worry, even if you think it's unlikely, or is it trade concerns? Is it politics in the US? If you look at your 2 to 3 biggest concerns, what are they?
So my two biggest concerns, obviously, one is the macroeconomic environment. Obviously, we see a V-shape, but if there is a second wave of COVID and this is not well managed, this scenario could change. The second is the rhetoric of the central banks, because the market has been very correlated to what central banks and fiscal and government have been doing. So if the rhetorics change, if the stimulus package doesn't go out how it's expected, this could have an impact on the market, because the sentiment of the market is becoming more volatile, I would say. We follow something we call a newscaster, which tries to take out the sentiment of the press about what investors are saying of the market. And we see that in these last 2-3 days, the sentiment is becoming more negative.
a negative on infections, even if we have a resurgence of infections before we get a vaccine, how do you model that, and what kind of impact does it have on equities?
So we believe that for the moment, if you look at economical data, they are quite on the upside. And is it the housing market or some Japan's trade stats that came out today? They are still positive. If you look at earnings, I think 80% of the S&P 500 company beat their estimates. So I think this is quite good. What we see is more how investors are talking about the market. How do they see equity market reacting in the future? And because there is more uncertainty of this second wave, we could imagine very easily investors taking profit. So it's more about market sentiment, which is less positive, rather than the macroeconomic scenario, which we believe for the moment the data are quite good, and we believe in a V-shaped recovery.
A V-shaped recovery for the whole world, or are there parts of the world that will deal with it better? And is there a direct correlation with how they handled COVID-19 and opportunities in the market?
I think obviously how we handle the COVID-19 is quite important, but what is more important than that is that the COVID-19 is an exogenous shock that could have an impact, recession, if the central bank and the government wouldn't have acted. It's the first time that we see fiscal policy and monetary policy moving together in most of the countries. The first time that we see a sort of European Union agreeing to have common debt. So that we've been going a long way. If you look at central banks, what they've put on the table is twice what has been put on the table in 2008. So I would say that there is quite a synchronized effort compared to 2008 around the world. Would it be in Asia? Would it be in Europe? Would it be in the US? And also, it's the first time that we see fiscal and monetary policy in the main developed country going together, which is also a very positive signal. So we believe that central bank and fiscal policy will be there to cushion whatever impact the COVID can have on the short term.
So until when, Fiona, when you look at equity highs that we saw in a lot of U.S. markets, especially technology stocks, what will it take for that to correct? Is it just a trend that was meant to take 4 or 5 years, maybe, the move to more technology, possibly the move from working from home and all these virtual conferences, and is that just accelerated? So does that support, fundamentally a conviction in some of the tech stocks, or are you worried about valuation?
We're worried from some of the valuation. If you look at the valuation of the S&P 500, I think the valuation is around 22 times PE. If you look at the valuation of the 5 stocks, I think it's 10 points higher, so it's around 30 PE, 30 times PE. And if you look at the valuation of the others, 495 stocks, we're around 20 times PE. So what is interesting is that depending where you look at the market, some part can look expensive and some part can look less expensive. What we hope for is that if global growth continues to be seen in the numbers, there will be a rotation a bit about these expensive stocks, although they have great future perspective. They are quite expensive and therefore a lot is priced already in it. So we would expect a rotation from these stocks to the other part of the market, which have still been lagging since the beginning of the year.
Fiona, final question on gold. What do you do with gold?
Gold has become a substitute for bonds. And it's a perfect asset that plays 2 roles. Because before, gold was not so interesting because you had to pay for the storage or whatsoever. So you would rather prefer to have government bond. But today, even US government bond has negative real yield. So in fact, gold serves 2 purposes in a portfolio today. It's a defensive asset, which can protect in a downturn. And second, it's an inflation an asset that can protect inflation. So yes, we tend to believe that it's interesting to have gold in the portfolio.
Thank you so much, Fiona Frick, there, Chief Executive Officer of Unigestion. Coming up, we'll have plenty more on the virus. Coming up, we'll have a full roundup of what we also heard from the German Chancellor, Angela Merkel, as a country records its biggest spike in coronavirus cases for nearly 4 months. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. So let's get straight to the Bloomberg Business Flash, because there's a lot to talk about when it comes to corporate news. But let's start with the U.S. State Department asking colleges and universities to divest from Chinese holdings. It's warning them that tighter regulations could see some companies delist entirely. According to Bloomberg investigation, college endowments represent billions of dollars of investments in Chinese firms. Amazon plans to make it harder for merchants to ship products themselves. It means they'll be more likely to pay the company to handle the task for them, while new shipping rules means that sellers will have to honor 1- and 2-day delivery pledges. If they can't, they risk losing a coveted Prime fast shipping badge. Germany utility giant RWE is planning to raise up to 2.1 billion euros in a share sale. Well, the new stock represents 10% of its market value, but shares are falling this morning as the pricing came in at nearly 5% discount to yesterday's close. Well, RWE is hoping to use the money to expand its renewable energy operations. And Goldman Sachs has signed a deal with Malaysia to finalize its 1MDB settlement for $3.9 billion. The U.S. bank announced an agreement in principle in July, but it is now confirmed the pact doesn't resolve the probe by the U.S. Justice Department. 1MDB is a Malaysian state fund at the center of global investigations into corruption and money laundering. And finally, Maersk has raised its full-year outlook. The world's largest container liner says profit for 2020 will be between $6 and $7 billion. The company's CEO, Sorosoku, says that doesn't include the possibility of a second phase of lockdowns. The company was able to stay open for business throughout the crisis, but warns uncertainty still remains. And that's Bloomberg Business Flash. Now, on to other things here in Europe, and the number of cases are rising in Germany. Anthony Fauci, the top U.S. infectious disease specialist, says even when a vaccine becomes widely available, it will take time to get back to normal. He says the U.S. shouldn't abandon public health measures immediately. Well, Fauci spoke with Bloomberg's Quick Takes, Madison Mills.
It's going to take a while to build up a cumulative amount of immunity, either induced by the vaccine or by natural infection, to get to the point where you really have a veil of protection or an umbrella of protection over the community. That's not going to happen in the first couple of months of availability of vaccine. So we will not be able, I hope we don't, we should not abandon public health measures even when we do get a vaccine.
Well, that was Anthony Fauci speaking with Bloomberg Quick Take. Now let's get more with our Danny Berger. So, Danny, what was Fauci's assessment of the current state of the coronavirus outbreak in the U.S.?
Fauci voiced a lot of concern, Francine, over, he said, what was a worrying baseline rate of community spread of the virus. He pointed to a curve whose projection is still upward. Now, what he prescribed to help bring this back down is what he says the U.S. needs a uniform approach. That means more consistency in things like mask wearing as well as social distancing. He sees it as too disjointed at this moment to make sure that these virus case counts come down. But look, Fauci is a man who's acutely aware of the political climate in the U.S. He's been thrust into it, really. So he didn't go as far to say that there should be a federal mandate for things like wearing a mask. Not that he doesn't think there should be one. He specifically did say that it would make sense, but he says getting a federal mandate passed on something like that would be impossible. So for that reason, he's not recommending it. Interestingly, though, this is really his main point, that you need to have these uniform approaches because it could prevent lockdowns. For example, he says that the case rises in the South, you wouldn't necessarily need to lock down those economies if you had things like hygiene and social distancing, that it's not mutually exclusive between restrictions and normal life. You can have both of them. In fact, the measures allow for these. Now, finally, Fauci did weigh in on the current mail-in voting comments that we've been hearing about the post office. Now, he didn't want to wade into politics, but did say that people really should be able to vote in person and by mail, Francine.
Danny, European leaders also voiced concern on recent uptake in virus counts. What did Angela Merkel say about that?
Right, so Angela Merkel speaking for the first time since virus cases were rising in Germany, saying that we should not be expecting any easing of restrictions in Germany, that the virus needs to get under control. We have seen cases in the region reach their highest since about April. And she said that, look, this needs to be brought under control. Germany already requiring people traveling from infected areas to quarantine when they get back or produce negative test results. She also said that fines might need to be levied against people who are flouting the hygiene and social distancing rules. Overall, her message, mobility and contact, that's what's causing these virus cases to rise. So Germany really needs to be vigilant that the virus is still here, even if it's not visible.
All right, thank you so much. Our Danny Berger there with the very latest on the virus after that great interview by Quick Take of Anthony Fauci. Now let's take a look at some of the other events we're watching today. 10 o'clock this morning, London time, we'll get the final CPI reading for the euro area. 11 a.m., European leaders will meet via video conference to discuss sanctions on Belarus. OPEC Plus ministers are also meeting online at 3 p.m. to review strategies for compliance when it comes to oil supplies. And later today, the focus shifts to the U.S., where the National Economic Club, or Economist, I'm getting muddled, club will host a conversation with Richmond Fed President Thomas Barkin on the economic outlook. In the meantime, European stocks are turning higher. U.S. futures also, investors signaling continuing optimism in the post-pandemic rally after shares in the U.S. hit an all-time high. We also have gold slipping back below $2,000 an ounce. Well, Bloomberg surveillance continues in the next hour. Tom Keene joins me out of New York. We'll be speaking to Martin Searle of S4 Capital. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
The S&P and Nasdaq power to a record close. Lackluster session in Europe. On Capitol Hill, Nancy Pelosi hints the Democrats could compromise to seal a deal on more stimulus. Joe Biden becomes the official Democratic nominee for November's election. President Trump ramps up his anti-China rhetoric, saying he called off trade talks with Beijing. And easing on hold, Angela Merkel rules out further loosening of virus measures after Germany records its biggest spike in cases for nearly 4 months. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua in London, still working from home. Tom Keene in New York. Tom, it's an interesting day because we talk about Fed, we talk about policy, we'll look at inflation, and I think there are figures out of the Eurozone coming up shortly.
Also, the markets are talking as well. You've got the S&P 500 out to record highs back to the Valentine's Day. You remember Valentine's Day, Francine, and it was a different time and place. Seriously, folks, pre-pandemic for so many people, and the S&P 500 really getting back there to the record highs. But what I'd really focus on, Francine, is 1 day, 2 days, and now Wednesday, we are giving up that yield surge of last week, and that is a profound thing for global Wall Street.
Yeah, I'll never forget Valentine's Day 2020, Tom, because I think it's the last time I traveled pre-lockdown. So it's kind of like a milestone that you remember.
Ages away.
We'll have plenty more, of course, on those yields. Yeah, it feels years away. Let's get now straight to the Bloomberg First Word News in New York City. Here's Karina Mitchell. Hi, Karina.
Fran, good morning. Democrats have made it official. They've nominated Joe Biden to take on President Trump in November. Biden received the more than 2,300 delegates needed in a virtual roll call that was a video tour across the nation. Past Democratic stars like Bill Clinton and future ones like Alexandria Ocasio-Cortez made short appearances. Meanwhile, the Trump administration sees a path to a pared-down $500 billion stimulus deal. Bloomberg's learned the package would eliminate the biggest areas of disagreement between Republicans and Democrats. It would include financial help for the Postal Service, aid to schools, and money for businesses to keep their workers employed. House Speaker Nancy Pelosi suggested Democrats might also agree to a smaller deal. And President Trump is raising questions about the future of that trade deal with China. The president says that he called off last weekend's talks with Beijing. He said he doesn't want to talk to China right now. The president called China's handling of the coronavirus, quote, unthinkable. And the coronavirus outbreaks in Florida and California are showing signs of easing. In California, the number of new cases was less than 60% of the 14-day average. Hospitalizations rose slightly, but are now down almost 30% from a peak in July. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Karina, thanks so much. Greatly appreciated. Equities, bonds, currencies, commodities. Let's go to the equity market right now. What's interesting is the VIX really didn't move yesterday on the SPX, moved 21.64 on the VIX. Yeah, futures up a little bit today. I'm going to call it fractional. Dow futures up 24. NASDAQ on a percentage basis still leading. We've really had a relative resurgence in tech stocks off of what we've seen from small cap over the last number of weeks, that back and forth between the two groups. There's a key statistic for me, negative 1.0536. We go to 4 digits on Bloomberg Surveillance, and that's the real yield. That's the nominal yield less inflation expectations, and you get a big fat negative real yield. That is coming down to an ever greater negative yield. We're not through to record negative yield, but nevertheless, that's been a 3-day reversal. Dollar not playing today. Francine?
I feel like it's a fancy data check for Wednesday, Tom. I feel spoiled. My data check is more simple. European stocks turning higher, U.S. futures as well. Investors now seem to continue, signaling optimism in the post-pandemic rally after shares in the U.S. hit an all-time high on Wall Street and gold slid back to $2,000 an ounce. Again, it's interesting because treasuries are rising before the Fed releases its minutes. It may give us clues about inflation targeting. Speaking about inflation, Euro area July consumer prices down 0.4%, a touch below estimates. Core prices actually pretty much in line with what we were expecting year on year at 1.2%. Now, to talk about inflation, to talk about some of their positioning, we're delighted to be joined by Mark Dowding. He's Blue Bay Asset Management Chief Investment Officer. Mark, thank you so much for joining Bloomberg Surveillance. What do you see right now in European yields? Where do you want to be in?
Well, in many respects, it's a quiet summer. We're seeing markets in pretty benign fashion and risk assets climbing a wall of worry. As you said, we've pushed to new highs in stock markets. We're seeing credit spreads grinding tighter, and for the time being, you seem to want to own the assets that the central banks continue to buy. So owning bonds in the European periphery, owning investment-grade credit is areas that you want to be positioned. But there is a sense that we have that maybe some of the best of the rally is now behind us. We've seen several very strong months, and frankly, we've seen a period where economic data has been getting better. The news flow, generally speaking, has been a constructive one. Going forward from here, we're wondering whether the bounce may start to peter out to a degree.
But there are fundamental shifts, Mark, in, Tom and I are basically drowning in news every day. And the market, as you say, is taking a fairly simple view of what's going on and kind of steady as they go because of what the Fed and other central banks are doing. Is there a worry that they miss some of the fundamental shifts, for example, in trade relations or how they model a Biden administration?
Yes, well, I think at the moment what we've seen over the course of the last few weeks is there have been a number of tail risks, whether it's to do with the US fiscal package, whether it's to do with the virus itself, or trade talks, for example, sort of tail risks that had the potential to disrupt markets, but none of them have really materialized or masticized in a really sort of nasty way to really lead to a bigger market correction. And so for the time being, markets seem to be still trading sort of in a pretty benign fashion. If anything, it was kind of interesting, and you've been highlighting this, how actually in the course of the last few days, it almost seemed like a bigger threat to the rally in risk assets could actually be coming more from a rise in long-dated government bond yields. And that was linked in part to some concern that maybe inflation sort of numbers were starting to build. But intrinsically, we think it's a bit too early to get concerned about that. We're still in an era of yield curve control. And so although sort of good news leading to higher yields could actually be the thing that ultimately derails this rally, for the time being, it is difficult to really project a really substantive move in yields at this particular point being a sufficient catalyst.
Mark, good morning. Tom Keene in New York. Alice Gledhill at Bloomberg writes up Blue Bay Asset Management on these hybrid securities, COCOs, in the idea of traipsing through the bank stocks by using COCOs. Explain that strategy that Blue Bay was featured on.
Yeah, so here, one of the parts of the credit market that we've really liked over the course of the last couple of years and continue to like a lot have been bank credits. In a way, in the last recession in 2008, we saw banks very much at the eye of the storm. They got beaten to bits. At the time, banks took a lot of risk. They didn't have sufficient capital. And so banks were certainly not a place you wanted to be as a credit investor. But in the current recession that we're seeing, we're now looking at banks with very strong capital buffers in terms of tier 1 ratios. We're also seeing banks take a lot less risk than they used to take. Actually, a lot of the risk that exists in markets has now really been sort of packaged off elsewhere. So we actually think that banks are rather boring, and boring is good as a credit investor. It doesn't mean that we're very bullish about bank equity stocks. However, buying high-yielding securities, these subordinated COCO securities from banks, which may be yielding sort of 5-6% to us, looks like a really good place to actually have your money in a really low-yielding environment. So this is an area that we've really wanted to focus on in terms of searching for value in what is a very low-yield landscape.
But what Alice Gledhill nailed in this article, folks, been basically viral within the fixed income community, is the idea of, is it too late to take part? Mark, we're in August. We're heading for September. As you mentioned, record highs in the equity market. Is it too late to take advantage of these relatively sophisticated strategies? And the American phrase is the boat left the dock.
Well, not yet. I think that as an investor, you're always looking at relative value across assets, and you're asking yourself, where has the rally gone too far? Where is it overextended? Where is value depleted? And where are there still pockets of value that you can really play for? And relatively speaking, we do see bank securities as being cheap. We think that CoCos are very interesting relative to a lot of other assets in the fixed income space at the minute. So we would always sort of speak to investing more over the medium term than over the very short term. But intrinsically, we still see a lot of value in these sorts of assets.
So, Mark, when will they no longer be cheap? I don't know whether there's, a point where you say, okay, enough is enough.
Yeah, well, so these junior securities, the CoCos, are what we call tier one securities, and one of the things we look at is the valuation on the next most senior securities the banks issue up the value chain, and so the next most senior securities would be tier two securities, and so if we see this gap between tier one and tier two securities tighten materially, we would then say that there's not a lot of value, relatively speaking. But at the moment, that gap remains elevated. And frankly, even if the recession does its worst, we think that there's a very, very low risk of CoCo debt being written down as a result of actually triggering the capital triggers in these assets. And so actually, for the risks that one is taking, we actually think it's a smart place to be investing for now.
Well, Mark, thank you so much for that briefing, and we will continue. Mr. Dowding is with Blue Bay Asset Management. I really can't say enough, folks. If you're interested in global Wall Street, look to Bloomberg bond coverage out at Bloomberg.com, and, of course, on the terminal. The story by Ms. Gledhill was really industry-leading 2 days ago, I think it was. Coming up later, always interesting, David Malpass of the World Bank. There is a pandemic out there, front and center for Mr. Malpass and his bank. In the 8 o'clock hour. This is Bloomberg Futures. Futures advance up 5.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Some things you see coming. Some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
If you want a president who defines the job as spending hours a day watching TV and zapping people on social media, he's your man. Denying, distracting, and demeaning works great if you're trying to entertain or inflame. But in a real crisis, it collapses like a house of cards. COVID just doesn't respond to any of them. To beat it, you've got to actually go to work and deal with the facts.
The former president managing the message over, and I really wonder, folks, you want, for our global audience particularly, the play in the zeitgeist in America is extraordinary. Do we go back to a traditional convention when the pandemic's over? I'm not sure on that. I'll leave that to David Weston and Kevin Cirilli giving us convention coverage, but just absolutely extraordinary. Whatever your politics, the last two nights on this new way of messaging, almost the infomercial of it, fascinating to see where we are 4 years from now within the convention strategy of the two parties. Right now, our strategy is to get smarter on fixed income. With this Mark Dowding of Blue Bay Asset Management, he put us to sleep. I nodded off to sleep. I hit my head against the microphone here, folks, talking about COCOs. Let's do something basic as well. Mark, tell me about the nominal yield. Help me with the nominal yield of full faith and credit debt. What's it going to do over the next year?
Well, in terms of looking at the absolute level of yields, we need to start by the understanding that we're in a world where cash rates are lower than they ever have been. And so one has to look at sort of yield levels which seem to be defying logic, I'm sure, to many of your viewers. But we need to look at these in the context of the level of cash rates which are prevailing, and maybe an expectation in markets that cash rates are unlikely to actually go up at the Fed or the ECB, maybe for the next 3, maybe for the next 5 years. And so in this world, I think we've got to get used to very low yields for a long time to come.
Right.
We think we're going to be in a world where actually when we look at credit indices and the yields on credit benchmarks, they're probably going to be edging slightly lower over the course of the next 12 months. Maybe we see government yields start to move a little bit higher. But in this world, we should see returns which are better than cash, albeit much less exciting than we've been used to receiving in the past.
But Mark, basically, as Mr. Gross of PIMCO said, it's financial repression. He said that a few years ago. Mark, the money question this morning is, what does your world do to the stock market? When we finally get through this, do you perceive a stock market that can manage its way out of this bubble or whatever you want to call it? Or is there going to be shocks to the equity market linked off of what we see in fixed income?
Well, I think you're moving into a world where effectively the short-term risks have been mitigated in equity markets as a result of the policy action that we've seen, but you're potentially storing up problems for the future because clearly if you end up in financial repression driving very high PE ratios, at some point, as and when the policy stimulus begins to be unwound, if that triggers a more material rise in inflation and yields in years to come, at that point, if you see the discount rate from the bond yield go up, that can only mean that the equity market is likely to go in the other direction. And so I think in the here and now, it's enjoy it while you can as an equity investor, and financial repression is clearly driving stocks to new highs, certainly in the US. But you may think that in quarters and in years to come, we're probably likely to see a pattern of increased volatility and maybe more uncertain returns for equity investors. And I think, frankly, we need to understand that in a world of 0% interest rates, it's kind of a bit inappropriate to expect equity markets to go up 10% every quarter as they have done, maybe in the last few months.
And Francine, that's a surveillance break exclusive right there. Mark Dowling saying we're not going to see up 10% every quarter. I think that's important on a Wednesday.
Mark, what would be the catalyst for this change? Is do you have to see inflation, and do you have to really have strong, rampant inflation, or does a touch of inflation also change everything?
Well, I think a touch of inflation won't do very much because, if anything, central banks for the time being have been saying that they're happy to sit behind the curve and actually hold rates steady to correct for the past inflation undershoot. So I think that in order to be sort of talking about a materially different environment, you probably need to reach a point where the output gap is being closed, and we're sort of projecting a more robust growth environment. And so this may not be the case until at some point in 2021 that this is a factor that we need to be concerned about. But sooner or later, we're going to reach the point where higher yields are going to be problematic for equity investors. I just don't think that that's going to be the issue in the here and now. If anything, if there's a catalyst in the short term for equities to struggle, it may be more from growth disappointments rather than from the idea of higher inflation just yet. It's just too early to get bearish on inflation or bearish on central banks, but it will be a factor over the medium to long term.
Mark, thank you so much. What a terrific briefing. Mark Dowding there, Blue Bay Asset Management Chief Investment Officer. Now, coming up on Bloomberg The Open, we'll have a conversation also on markets and fixed income with Kate Moore, BlackRock Head of Thematic Strategy. That interview, 9 a.m. in New York, that's 2 p.m. in London, and this is Bloomberg.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Investment bank merger is something we have been discussing actually for months. This is not a cost exercise. There will be some cost benefits, but it's really about having one underwriting business, to have one investment bank globally, one equities business.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. I'm Karina Mitchell. Let's get the Bloomberg Business Flash. Takeda Pharmaceutical reportedly is making final arrangements to sell its Japanese consumer healthcare business to Blackstone. According to Kyoto, the deal would be worth more than $2.8 billion. Takeda has been in a divestment mode since buying Shire last year for $62 billion. Bain Capital has agreed to pay $543 million if it fails to buy Virgin Australia Airline. That unusually high breakup fee helped win over the collapsed airline's administrator. Virgin's creditors will vote on the proposed deal September 4th. And the world's largest container ship line has reinstated its full-year guidance at a higher level. A.P. Møller-Maersk reported second quarter EBITDA that was close to the highest analyst estimate. The Danish company says it was able to serve customers under very difficult circumstances. And that is the Bloomberg Business Flash.
Karina, thank you so much. Greatly appreciated. Equities, bonds, currencies, commodities. Euro on a surge now, not through to recent record highs, but nevertheless, it gets our attention. I hear 119.50 on euro. No, I'm not going to round it up to 120 yet. Equities, they elevate today. The VIX 21.60. Francine?
Dom, if you look at European stocks, so they are turning higher with these U.S. futures. So they seem to be following U.S. futures impetus. A lot of the focus is on optimism in the post-pandemic rally. I do think there is a correlation, as you rightly said, Tom, with yields and equities. Gold actually slipping back below $2,000 an ounce. We had some better than expected news when it came to inflation here in Europe. And then we also had some lingering questions, which is why the market in Europe certainly was a little bit off this morning over the future of the U.S.-China trade pact after President Trump said he called off last weekend's trade talks. So we'll talk trade, we'll talk equities. We'll actually talk U.S. politics and advertising with Sir Martin Sorrell, the S4 Capital chairman and founder. He's coming up shortly, and this is Bloomberg.
Since COVID ianze hatujakuwa tukienda kazi, so maisha imekuwa ngumu na inazidi kukua ngumu. So swali yenye tunajiuliza, kama hii imefika 1 million plus na situation cases bado zinaendelea kuenda juu, zikifika 5 million tutakuwa aje?
Hizi gari za biashara tumekosa pesa ya kulipa, hata the more inaonekana inaendelea, hata itabidi turudi ushago juu biashara imeharibika kabisa, hata tujui tutafanya namna gani.
a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Karina Mitchell. Let's get the Bloomberg First Word News. Joe Biden is shooting down President Trump's attempt to paint him as a puppet of progressives. Democrats formally nominated Biden to face a president in November's election. Last night, the virtual convention included testimonials from the party's own guard, such as Bill Clinton.
The president who defines the job of spending hours a day watching TV and zapping people on social media, he's your man. Denying, distracting, and demeaning works great if you're trying to entertain or inflame. But in a real crisis, it collapses like a house of cards. COVID just doesn't respond to any of that. To beat it, you've got to actually go to work and deal with the facts.
A joint keynote address featured newcomers, mostly from the party's centrist wing. The Trump administration is considering tighter sanctions on Venezuelan oil. Bloomberg's learned the measures could target crude swaps with companies in Asia and Europe. Last week, the U.S. seized the contents of 4 Iranian tankers carrying gasoline to Venezuela. Venezuela can't produce its own gas because of widespread mechanical failures at refineries. And we'll hear more in the coming days from the Postmaster General about his decision to suspend changes to the mail service until after the election. Louis DeJoy will testify in front of Congress on both Friday and Monday. Democrats and others were concerned that apparent mail slowdowns could hurt voting by mail. And Saudi Arabia is keeping up the pressure on OPEC Plus nations that have been exceeding their oil output targets. Saudi King Salman called the president of Nigeria to emphasize the importance of complying with production limits. OPEC and its allies will discuss compliance today on a video conference. Nigeria, Iraq, and several other nations consistently fall short of pledges to limit output. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Tom, Fran.
Karina, thank you so much. Greatly appreciate it. This is the interview of the day. If your life has changed by the emptiness of our cities, if there's one thing Francine and I have seen over the recent months, it's the sheer global emptiness of our cities. Someone who's filled that office space for decades, back to his acquisition of wire and plastic products a few years ago, was a young Martin Sorrell. Sir Martin joins us today. And Sir Martin, I've been dying to ask you this question. Is the office...
Am I an old Martin Sorrell now, Tom?
No, you're well preserved. What I want to know, Sir Martin, is the office dead? You're the one that put thousands of people at WPP into offices, creating that energy. Is work from home really the future?
Well, I think it's going to change, Tom. I mean, I know there's a lot of controversy about that, particularly real estate developers don't like to hear this, but if I talk from our own experience at S4, we have 2,600 people. We actually increased the number of people in S4 since the beginning of COVID. We've gone from about 2,400 to 2,600. So we're hiring as the holding companies are jettisoning about 50,000 people and making provisions for all that real estate. Omnicom took a provision against 1 million square feet in their Q2 numbers. IPG, 500,000 square feet. What we're finding, and our workforce, Tom, is a young workforce, despite the fact I'm 75. I'm the senior monk, as they call me. On the content side, we have 2,000 monks whose average age is about 32. We have about 600 mighty hivers on the media side whose average age is about 25. They're on the young side. They tend, some of them work from home from their parents or work from home from their parents or as couples or with kids, and they lack the resources. So those people probably are a bit more reticent to Jess's offices. But generally, Tom, to answer your question directly, our people want to spend about 2 or 3 or 4 days in the office. They want to be living in more dispersed parts of the country, whether it be the US or the UK. We're in 30 countries. So I think working from home and dispersed working, given the level of connectivity we have, and our people are not just digital first, they're digital natives. I mean, this is bread and butter for them. And even before COVID, they were working 24/7 from home in a flexible way. So flexibility on commuting, Tom. So not having to come in at 6 or 7 in the morning or go home at 7 or 8 at night. but being able to flex.
So I don't mean to cut you off because of time. Francine wants to get in here, Sir Martin, and I got one more question on this, and I know Francine wants to go in another direction, and that is simply, what is the government policy that would be most efficacious? What do you need from Prime Minister Johnson, the next president of the United States, whoever that may be? What's the policy that moves business forward pre-vaccine?
Well, vaccines are critically important, and I think by Q2 of next year, we'll have an approved, regulatory, distributed, and vaccinated population. Now, there is the big question about whether people will be vaccinated or not. I saw a poll in the US which said a third would not. But essentially, to come back to what needs to be done, hardware and software infrastructure, a re-education, reskilling. COVID-19 accelerates what's happening on digital transformation, digital disruption, and makes those public-private partnerships where we reskill and re-educate workers even critically more important. I read an article this morning, 750,000 job losses in the last couple of months here in the UK. The furloughs here have postponed the evil day. The furloughs come off in October. We will see an acceleration of unemployment. Technology, in my view, destroys jobs. You know, people talk a lot about purpose. The purpose of S4, we put it very simply, is to create jobs in our industry at a time when our industry is shedding jobs, when they're shedding real estate. What we're trying to do is employ more people and give them encouraging and careers. Yes, Francine.
So how much advertising spending is there out there? What sectors, what companies are ready to spend in this kind of environment?
Well, the V-shaped sectors, as I call them, would be the tech sector, obviously healthcare, in-home games and entertainment and online shopping. And even the established retailers, those that have moved their model to an online model. 1/3 of the US population are trying to buy or have tried to buy and succeeded in buying online essentials and food during the pandemic. We saw with SARS in China a massive shift of the Chinese consumer to online. So everything we're seeing, Francine, through COVID-19 is just accelerating digital disruption and transformation at the consumer level, education, communication, things like we're doing here now. I'm sitting talking to the office instead of coming into the studio. We're seeing it at a media level. We're seeing newspapers and magazines dropping like flies because the paper versions aren't profitable and they aren't environmentally friendly. And last but most importantly, enterprises are accelerating their digital disruption and transformation. Yeah. There is no status quo anymore, Tom, Francine, to disrupt. Well, if you're going to take an exceptional charge for digital transformation, the profitability in Q2 was a disaster. So what do? You get on with it as quickly as possible. Average life of a CEO is about 5 years. Now, the whole stage has been disrupted, so you might as well get on with the change. And the catalysts are huge. We're going to disrupt here with Sir Martin and come back with him and continue this discussion. Tom Keene and Francine Lacroix with futures up 6, Dow futures up 52. Coming up on Balance of Power, I'm really looking forward to this. Cass Sunstein, you know I loved his book Impeachment, where he didn't mention President Trump's name even once. Cass Sunstein on our judiciary and Cass Sunstein on the politics forward in the 12 o'clock hour today with Mr. Weston. Stay with us with Sir Martin Sorrell. This is Bloomberg.
We were laying down in the bed, just sleeping, and it startled us. All of a sudden, we hear this big tremble. It trembled our house, and then it shook our bed. And we was like, what in the world was that? I didn't know what it was. Honestly, I didn't even know if it was earthquake or not. It really startled me. didn't even know that earthquakes actually exist in North Carolina. So I was really startled. It was small, thank God. Nothing happened to our house, nothing broke. I just didn't realize that it would happen here in North Carolina, honestly.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
We know it's a pandemic, and we want to be very responsible for pricing. We plan to underprice this vaccine for its value, especially in the pandemic phase.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Well, let's get back to Martin Sorrell of S4 Capital, who's still with us. We were talking with Sir Martin about some of the landscape, who's spending, who's not, digital natives, and of course the fact that maybe some of these trends in terms of the technology were accelerated because of COVID-19 by a couple of years. Sir Martin, I want to ask you about the U.S. election. What does it mean for spending? If we don't have natural conventions or normal conventions, but we do everything by video, is it good or bad for the advertising world?
Well, what we've seen, Francine, you have to remember that S4 is a purely digital company, and we claim to be faster, better, cheaper, and that actually is showing up in reality. But what we're seeing is a few things. Firstly, animation has gone through the roof. Secondly, robotic camera work and robotic production has gone through the roof. And then thirdly, the conversion of live events to online events. And as you saw with the convention, or you're seeing with the convention, it's conversion to an online event. And people forget that the tech companies, which is one of the V-shaped sectors that I mentioned, the way they sell their products and their licenses is through conferences, live events. You know, they have 10,000, 20,000 people in Las Vegas or San Francisco or where it happens to be. What we've done is been heavily involved in converting those events to online events. For example, on sports, you know, we entered into agreements now with some of the major leagues on converting their live events to virtual streamed events, using very advanced photography and camera work and streaming devices to make the experience for the crowd, for the fans even more interesting. So it's not true to say in the digital area. I mean, media spending this year will be about $500 billion. Last year it was about 550 to 600. The compression has come on the traditional side. The ad holding companies in Q2 were down between 10% and 26%. That was the worst. MDCI, I think, a smaller holding company, was down by a quarter in Q2. We're yet to see what happens with WPP, but it sounds from what we're hearing it's somewhere like 15 to 20% down in Q2. We were up in Q2 with a purely digital company. We bottomed in April. We improved. We had positive growth in April, around 3%. We improved in May to 5%. You'll see when we announce our results on September the 19th or September the 9th, what happened in June. We went up and we said we've indicated double digits in June. And in July, we had a very strong start to the second half. So digital advertising, Francine, is very strong. Still.
Okay, but is it enough to replace normal advertising? And we'll have to see what WPP say and things like that. We don't know yet. But just in terms of trends, if everything moves online, you may benefit because you're in the digital space, but will a company just spend less on advertising, or do they spend that money on technologies?
Procter, for example, I mean, we haven't mentioned the package goods there, which are much more U-shaped sort of recovery. But with Procter, it's a very narrow U-shape because you can see they were up 6% in Q2, the last quarter of their fiscal year. And what's happened there is because of their product portfolio, they're out of food. Unilever still have a food business, home service or food service business, ice cream business, which is affected by lack of distribution. But in the packaged goods sector, the focused packaged goods companies like a L'Oreal, like a Nestle, like a Mondelez, they tend to and their product portfolios tend to react better. They're much narrower U shape. The L shapes obviously are travel and hospitality, but the four I mentioned in terms of tech and healthcare, in-home and gaming and entertainment and online shopping obviously make up for it with a very strong V-shaped pattern to it. And the answer to your question is digital advertising this year will be about the same as it was last year, maybe up a little bit. It's the traditional areas of TV, free-to-air network TV, traditional radio rather than digital radio, traditional outdoor, print under pressure. You know, Rupert Murdoch closed what? 100 titles, was it? Over 100 titles in Australia and New Zealand just recently.
Right.
We're seeing so many newspapers and magazines in their old formats. It's not that news is out of fashion; it's in fashion. I mean, Donald Trump, the president, really probably has been the single most important factor for the news industry, for you, Francine, for you, Tom, in terms of people watching and listening to your programs. So I think the digital landscape is set fair. It's now about 50% of that 500 billion, about 250. We reckon by 2024 it'll be 2/3 of the market, and will continue to grow into Q3 and Q4 and into 2021.
Sir Martin, I've got one final question. I got like 8 ways to go here, but I got to go back to something you just said moments ago. Do we blame you for the crowd noise in the Premier League football games? Is the crowd noise your fault?
No, it is not our fault. And I must say, it's not good watching. I watch cricket, Tom. It's not good watching a silent cricket match. The Pakistanis, actually, when they're on the field, they talk an awful lot. In fact, I saw a little clip which analysed what the Pakistani fielders were saying, if you understand what I'm talking about, what the Pakistani fielders were saying whilst the English team were batting. But quite interesting. But no, I prefer the crowd noise, and so I don't mind it. I disagree with you, Tom.
Okay, very good. Sir Martin Sorrell, thank you.
All right,
so
Sir
much.
Martin,
Thank you, Tom. Thank you, Francine. Thank you.
Tom, I have like 2 minutes in the break to teach you about cricket.
I'm trying.
He's
I'm
never
trying.
watched cricket, Sir Martin. So
it's
we
hopeless.
need to.
John Riding has been helping for years, along with Raghu Rajan and Francine. I'm working on it every day. Every day.
Yeah. Leave it with me, Tom. You'll be briefed. Martin Sorrell, S4 Capital Chairman, joining us. Up next, Martin Ratz, Morgan Stanley Global Oil Strategist. This is Bloomberg.
isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now let's get on to commodities. And oil prices have eased from a 5-month high after a report signaled that U.S. gasoline stockpiles are actually surging. It comes ahead of a meeting of OPEC and its allies to assess its supply agreement. Well, joining us now is Martin Ratz. He's Morgan Stanley Global Oil Strategist. Martin, great to have you on the program. What are you expecting to hear from OPEC Plus? And actually, it's been pretty much stable, you know, independently of what everyone has been saying. So what can OPEC Plus actually do?
Yeah, thanks for having me. You're right to point out that after the very tumultuous and exciting March and April months, the volatility in oil prices has reduced quite a lot. And prices have been much more stable recently. Having said that, though, even though prices look much more stable, there's still an awful lot going on in the background. If you look from a top-down macro perspective at the oil complex, it's sometimes useful to simply realize that oil is just another commodity, and or at least to take that perspective, and to say, when do commodities do well? Well, they do well when the dollar is weak, when we start getting worried about inflation, when we have economic recovery, when we have growth in the money supply. Recently, we've had all of these factors that has provided a great tailwind to the broad commodity complex, and oil has also benefited from that. But if you then look at the bottom-up sort of barrel counting perspective of the oil market, you're seeing more signs of weakness. The demand recovery is still very fragile. Some of the curtailments in North America are slowly being unwound. Chinese imports are starting to soften. Refining margins are very low. And within that relatively complex set of top-down and bottom-up factors, OPEC needs to strike a balance. My expectation is that they simply will execute the plan that they communicated to the world back in April, and they simply execute that schedule, which is effectively set until well into 2022. So an incremental 2 million barrels a day in August was the plan, and I think that's the schedule that they're on.
But Martin.
Okay, guys, I'm placing a stop for euro at 119.345. Stop on profit for 119.345. Okay.
I think it's very important that they stick to the agreement. I mean, the OPEC Plus group is a very large number of countries, and to orchestrate production cuts of this size and relative to the agreed baseline, OPEC is running now minus 7.7 million barrels a day. I mean, this is a historically large OPEC cut. So to have this deeper cut agreed by so many countries, I think the only way to really be successful, or to kind of to keep the group together, is to simply execute on the plan. And the plan that was set out over the Easter weekend back in April is a very long-term plan. It has scheduled unwinds of these cuts.
Position closed on euro at 119.345.
Unwounds would open up so many, topics of negotiation again. The only way forward is to simply stick with the plan. In August, the quota is a 7.7 million barrel a day cut relative to July, when it was still a 9.7 million barrel a day cut. So, but all of that was already negotiated as per April, and I think simply for the coherence of the group, they'll need to stick to the original agreement.
Martin, Tom Keene in New York, good morning to you. I want to go to your physics background and your really, really thoughtful note on the future of big oil. It was on European oil, and we don't talk about individual names here. But Martin, I just want to go to the law of motion here. Are these big oil companies at rest, or are they actually in motion and will stay in motion towards some new paradigm?
Oh, they are in tremendous motion. The rate of change that is already taking place and will become more apparent over the next several months and several quarters is phenomenal in these companies. The coronavirus crisis has led to a structural rethinking of strategy on a sort of 5 to 10 year view in all of the European oil majors. There is a clear realization that betting on or assuming this sort of open-ended structural oil and gas demand growth year after year, as we've been accustomed to for decades, that may still happen, but it's much more of an open question, and there are scenarios where that simply doesn't happen. And if the traditional fossil fuel business enters a new paradigm, then also other businesses models need to build up new energies, renewables, all these things. And there's a huge degree of change going on there that we will hear more
but is it
in months to come.
Very quickly here, we're going to run out of time, Martin, but it's an important question. Are they going to be able to maintain cash flow for dividend payment with the new paradigm they're heading towards?
Yeah, frankly, this is the billion-dollar question, that we put it mildly. So all these dividends have been reset lower, or at least the vast majority of them have been reset lower, and that really helps. The problem with the energy transition is that it's hugely capital intensive. Now, in the fullness of time, that will be offset by, hopefully decent returns. But for a period, it could be 5 to 10 years. We're looking at very high levels of capital expenditure that are required to fund the transition. Producing a unit of energy from, say, a wind or a solar project is about 5 times as capital intensive as producing a unit of energy from oil or gas. So as you switch from one business model to the other ones, you're looking at a period which is a multi-year period of a capex hump to overcome.
We have to extend this conversation, extremely timely. Here's with Morgan Stanley, their global oil strategist, Martin Ratz. Really can't say enough about the engineering that he brings to his analysis. We're going to engineer forward to foreign exchange. Really, it's simple, dollar weakness, and we're seeing that sustained today. Daniel Katzev, BNP Paribas. From London, from New York, futures up 6.